Hello, everyone. Welcome to Search for Yields, weekly newsletter from INR Bonds. I am Nikhil, and in today's weekly edition of Search for Yields, I'll be discussing about why should an ordinary investor should stay away from high-yielding assets, in particular high-yielding bonds. Before we go to the topic, I would start with the relationship between the risk and returns. So generally in finance, when we start learning about financial concepts or about financial instruments, they say higher the risk, higher the returns. That means the more the risk you take in the investments, the higher the returns you get. So clearly, if you take the total investment spectrum, the FDs have the lowest risk, which is why they give the lowest returns. I'm talking about the FDs of the top cream banks. If you take the private equity investments, they offer the very high returns because the risk the private equity investor stake is very high compared to a FD investor. Similarly, if you compare it a top bank in a country, the FD rate which it offers will be relatively very low comparatively to a AA rated NBFC FD rate. Which is because the risk associated by investing or giving your money to a AA rated NBFC is quite high compared to a AAA rated NBFC or a AAA rated bank. So, which is why you get an extra premium for taking that risk. So, the bonds which are in the junk bond space or high yielding bond space offer returns over and above 11% compared to a AAA rated bond because these bonds carry extra risk, and also the investors should know about those risks before investing into such kind of products. So if you the latest example from this from the latest crypto lending is that the crypto lenders as such the companies which are lending money by taking the crypto coins as a collateral have asked the FD investors to pause their deposits, and also told them the withdrawals or the trading of the crypto coins won't happen on their platforms for some time. So the investors who invested in such platforms, these platforms were offering FD rates of 12%, 13%, compared to a FD rate of a bank where they're offering around 4%, that is an 8% spread or 800 basis point spread. Because these lenders operate in a very underlying asset is a very volatile, the crypto coins. In the year 2022 Y2D, the crypto coins have seen a price correction of more than 50%. That means if they're lending the money to someone by taking collateral of a crypto coin, the collateral value has halved by now. So that makes a complete liquidity issue at the end. They're not able to meet the redemption pressures, which is why right from the Wall Street, Singapore, and as well as the London, the many the crypto coin players, the lenders have asked so they were not able to meet the redemption pressures, and they won't be able to pay the principal to the FD investors. And the current scenario, if you take where the central banks are hiking interest rates very aggressively, which is also raising the borrowing costs for the corporates. The rising borrowing costs for the corporates, especially the lenders, will face issue in the fall in their net interest margins because of rising borrowing costs. And also corporates, on the other hand, given this inflation at all-time highs and the commodity prices are rising sharply, the corporates are facing the margin pressures, and as well as the cash flows will fall due to the lower profitability. So in this scenario, the most hit corporates would be the ones which are under BBB rated, which fall into the high yield space again. And also when the central banks tighten the interest rates, and as well as they suck out the liquidity from the market, especially the high yielding corporates, corporate bonds will see a sharp fall in prices because due to the risk aversion, the investors tend to panically sell off the high yielding assets and park their funds in a much safe haven assets like USD, which we clearly saw in the last 3 months, where the equities or the corporate bonds or these types of prices fell sharply. because of the risk aversion in the market. And the investors right now, even who are planning to invest in these high yield bonds, should clearly understand their own risk appetite before investing, and as well as they have to know the risk factors of the issuer as well. So we have a curated list of bonds on our platform, QuickInvest by INR Bonds. You can access this curated list of bonds through mobile app, which is the QuickInvest, available on both App Store and Play Store. So this curated list of bonds have the description of the issuer and as well as the INR Bonds risk score. The INR Bonds risk score is a proprietary AI-driven model which includes various risk factors, right from the issuer specific to macroeconomic, and as well as the credit spreads, the liquidity risk, and etc. So this risk score will tell you what is the riskiness of the issuer. And one has to understand their own risk appetite by asking a few questions or consult the financial advisor to know the risk appetite of theirs before investing into any financial instrument. Thank you for listening in, and do subscribe to our YouTube channel if you have not done so. Thank you.